Welcome back to The Explainer. I want you to imagine it's October 2008. The global economy has just stopped. Financing vanished. Economic activity slammed on the brakes. And the whole world is holding its collective breath. But here's the really wild part, the true mystery. If you were an economist watching this unfold in real time, your standard macroeconomic models, they couldn't explain this sudden violent halt. It didn't make sense. Productivity didn't just vanish overnight. Interest rates were actually pretty low, and demand was humming along right up until we fell off the cliff. So what actually broke? Well, today we're going to unpack some fascinating research that pinpoints the invisible currency we lost during that crisis, and why, honestly, our financial system still hasn't fully gotten it back.
So why did the global economy just stop spinning? To figure that out, we have to look way past the usual suspects. Sure, financial deregulation and relaxed monetary policy were happening, but those were just the kindling. The sudden shockwave that completely froze the system wasn't just about banks running out of cash. It was about people running out of something much, much harder to measure. You see, standard models kind of just assume that laws and contracts will keep the gears turning smoothly. But let's be real, legal protection is far from perfect. It's super expensive, it leaves massive loopholes, and it literally cannot force someone to lend their money if they are absolutely terrified they're never going to see it again.
The reality is, the massive gaps in that legal system are filled by trust. And we're not talking about trust as some warm, fuzzy emotion. In finance, trust is a hard, absolutely critical mechanism. It is literally just the calculated belief that the person on the other end of a trade is not going to cheat you. Think about it. When you hand over your savings, you are trading your actual money today for a promise of more money tomorrow. Without trust, that promise is completely worthless. And in the fall of 2008, that belief was just entirely shattered.
Okay, let's dive into Section 1, the collapse of trust, a shattered belief.
When the crisis hit, it wasn't just the trust between big banks that froze up. Researchers tracked a genuinely staggering drop in everyday confidence. Right after the crash, the Financial Trust Index survey revealed that a whopping 95% of Americans completely lost confidence in the system. 5%. That's it. Just 1 in 20 people reported having full trust in banks, brokers, mutual funds, or the stock market. To really put that into perspective, back in the late 70s, that number hovered around 40%.
And this massive plunge you're seeing isn't just some dry data point. This incredibly steep cliff right at 2008, that is an emotional barometer. It represents pure panic, anger, and betrayal. For years, people had been assured that their investments were completely safe, especially securities backed by massive titans like Lehman Brothers. So when the harsh reality of the crisis finally set in, that visceral feeling of being cheated sparked a massive, widespread run on the banks.
Which brings us to this highly relatable and honestly kind of shocking behavioral shift. Let's call it the stranger danger paradox. Now, before the crisis, Americans naturally trusted banks about 50% more than they trusted some random anonymous stranger. Which makes total sense, right? They're the custodians of our life savings. But look at these post-crisis numbers. People actually began trusting a completely random stranger on the street more than their own banker, more than mutual funds, more than the entire stock market. In our minds, the people guarding our wealth somehow became less reliable than a total stranger. It's wild.
All right, moving on to Section 2, the Madoff spillover effect. Let's look at what happens when fraud infects the system.
So what was the actual trigger for this intense systemic distrust? Well, it was the explosive revelation of opportunistic frauds. And the absolute poster child for this was the Bernard Madoff scandal. Now, a lot of people focus on the sheer size of his Ponzi scheme, which, by the way, was 0.5% of the entire US GDP. But focusing on the money actually misses the most damaging detail. Madoff wasn't just some fringe, back-alley criminal. He was the ultimate trusted insider. The guy was literally the former chairman of the NASDAQ stock exchange. When a professional at that level, an absolute pillar of the financial community, manages to trick ordinary people and expert institutions for 2 decades, it logically forces the average investor to ask, wait, who else is playing these games? You can see the psychological toll of this deception so clearly right here. Being deceived in the past inherently destroys future trust, and the data proves there is a direct, undeniable link. People who reported being cheated by a bank or an insurance company instantly drop their trust levels across the entire financial industry. It creates this massive social risk. The second you realize the person managing your hard-earned money might be hiding risks or manipulating commissions, your willingness to even participate in the market just plummets.
And this brilliantly illustrates that spillover metaphor. If you look at the geographical spread of Madoff's victims across the US and Europe, researchers found something fascinating. In states or zip codes with a high density of Madoff victims, trust in completely unrelated local banks, bankers, and brokers entirely collapsed. Think about that. Even if you weren't a victim yourself, just reading about it in your local paper or knowing a neighbor who got hit was enough to completely poison your view of the whole sector. Honest portfolio managers from Kentucky to Italy suddenly had to bend over backwards to prove they weren't scam artists. The bad actors ruined it for everyone.
Let's move into Section 3, the hidden costs of mistrust, and why this is so expensive.
So what are the actual long-term hidden costs when mistrust takes over? Take a second and just reflect on your own habits. Do you handle all your own investments these days? Are you super skeptical of financial advisors? When trust evaporates, investors get incredibly defensive. And let me tell you, that is a huge drag on the economy. We witnessed this massive flight away from ambiguous or risky assets like stocks, which suddenly made it way harder and much more expensive for innovative companies to raise capital. We also saw this heavy home bias, where people retreated entirely to familiar domestic assets. People were even multiplying their banking relationships. They were opening accounts across 3 or 4 different banks just to spread out the risk of being cheated, which honestly is super inefficient and highly expensive to maintain. But perhaps the absolute most striking cost of all this was the death of financial delegation. With trust gone, people flat out refuse to let the experts do their jobs. Usually high-trust investors hold much more efficient, highly diversified portfolios because they just let their banks handle the complex trades. But after the crisis, basically everyone demanded the final word, or worse, they completely micromanaged things themselves. We ended up retreating from the very financial instruments that were designed to grow our wealth simply because we were too afraid to use them.
Now for our final section, rebuilding financial trust. Let's talk about a voluntary shift. Okay, so how do we actually climb out of this hole? Well, the immediate instinct for most governments is to just slap on heavier regulations. But interestingly, cross-country data actually shows that stronger regulation often correlates with lower average levels of trust. So to genuinely cure this deficit, the change actually has to come voluntarily from inside the industry itself. Researchers have proposed 3 major actionable steps to get there. Step 1 is creating a Bank Fairness Index, a super easy-to-understand rating from 0 to 10 that scores a bank on how fairly it treats its customers, not just its credit risk. Step 2 is establishing trust-based compensation. And Step 3 is promoting robust financial education. Why? Because an educated investor is far harder to deceive, and any institution that sponsors that kind of education is sending a very clear signal that they actually want an honest, transparent relationship. Let's look a little closer at Step 2, because this one is a real game changer. Standard bonuses in the industry notoriously encourage managers to take massive short-term risks and basically hide the downsides from you. But what if we completely flipped the script? What if we tied a banker's paycheck directly to anonymous client trust ratings? Think about it. If a manager's compensation goes up and down based entirely on whether their clients genuinely trust them, suddenly their incentives are perfectly aligned with your long-term financial health. They would be highly motivated to be completely transparent with you. It fixes the root of the problem. And that brings us to the core takeaway of this entire explainer. Trust is the investor's belief that those who manage their savings and provide them with financial advice are trustworthy. It sounds incredibly simple, but it is profoundly important. Financial intermediaries simply cannot legislate or market their way back into our good graces. The only real way to regain this lost invisible currency is by actively and transparently investing in their own trustworthiness. They have to prove it. So we've seen just how fragile trust really is, how incredibly fast it can evaporate, and how deeply its absence freezes up the gears of the entire global economy. Which leaves us with a question that goes way beyond standard economics and hits right at the heart of your own financial life. Think about the institutions you deal with every single day. Your bank definitely has your money, but do they actually have your trust? Take a hard look at where your savings are sitting today and really ask yourself why. Thanks so much for joining me on this explainer, and I will catch you in the next one.